Hello student, welcome to Oriented Academy. Today we are going to start our next chapter, that is chapter number 8, and the chapter name is the sources of business finances. Let me help you to understand this chapter from the introduction point of view. As you know that the finance is the backbone of every business organization, and whether a business is being established, expanded, modernized or operated on a day-to-day basis, it requires adequate financial resources. Without sufficient fund, no enterprises can perform its activities efficiently or achieve its objective. The need of finance does not end with the establishment of a business. Funds are continuously required for purchasing fixed assets, meeting the operating expenses, maintaining working capital, introducing the new product, adopting modern technologies, expanding the business operations, etc. So, selecting a suitable source of finance become an important financial decision for every business enterprises. So we are talking about the money or the finance that is very much required in every business activities, in every day-to-day business and related tasks, and whether business has been established, expanded, modernized, or just has been established or being operated on a day-to-day basis. So there is a basic requirement of money, that is a basic requirement of finance that you definitely required at your business point of view, because without the finance, without the money, you cannot perform over all the tasks or the activities that is required for a business operations. So business need a money, business need a blood is a form of, in a form of its finance, form of in a money. So it will require, it will be performed on the behalf of finance, it will be performed on the behalf of money if you continue your business. So business definitely required for a different point of view. Money is ultimately required for purchasing a fixed asset that include the machinery, furniture, fixtures, and many other items. It will be useful for meeting the daily operation and related expenses in terms of sales, in terms of administrations, in terms of various other activities which require for a business and its operations. Apart from this, you need a working capital that will help you to manage your daily requirement of money that will require to buy raw material, processing of the raw materials, finished goods, and many other items that you regularly need. Sometimes you regularly requirement of paying to the vendor, paying to the particular person who demand the money from the business, and these kind of activities definitely need a working capital. Working capital is very much required from the current assets and current liabilities point of view, and working capital is definitely is backed by the finances. Without finances, you cannot manage your working capital on a day-to-day basis. Even you cannot introduce a new product that is being produced by the business point of view, or a new product or new service has been introduced in the market, so you have to market them, you have to advertise them. So all these type of activities, they also need a money. So once you start your business, once you adopt new technologies, once you are intended to expand your business operation, definitely you need a very good amount of money, very good amount of finance in your hand. So what are the sources of finances, what are the different sources of money you can understand from this particular chapter. Now deep dive into the particular meaning of the business finances. Business finances refers to the fund required by the business enterprises to establish its operations and carry out its various activities smoothly. Every business, irrespective of its size, requires a finance to acquire the assets, purchase of a raw material, paying to the employees, meet the routine expenses, and support the future growth. So this finance is an essential requirement of for the survival and development of every business organizations. So Understanding the meaning of business finance, in which you need money is a basic, or you can say a blood of the particular business, irrespective of its size, whether it's a small or big or medium size. Every time you need a particular amount of money that will be helpful for acquiring the assets, purchasing the raw material, buying the machinery, molding the raw materials, shaping the raw material into a particular product. So all these type of activities will definitely require finance. Apart from this, you need a finance to manage your labor, manage your say current assets, your current liabilities. Every time you have to go through a particular requirement of the money. So finance is an essential requirement for the survival and a growth of every business. If you continue to do your business, or if you perpetuate your business for a long period of time, then you definitely have a certain amount of money in your bank account, in your cash box, and every day you have to keep certain amount of money that will be very much required for a business point of view. If you are having a cash, if you are having a bank balance, then definitely it will help you to smoothen your business and its operations. Now we understand what is the significance, what is the role of business finances. First point of view that you can understand from the significance point of view, it will definitely have a fixed capital requirement, or you have to purchase a fixed capital or fixed assets. That might be possible only you are having a money, or you are having a finance in your bank account. So business require funds to acquire the long-term assets such as a land, building, machinery, furniture, and equipment. These assets will help the enterprises to establish its production and operation facilities, because when you are having a production or operation facilities, that might be helpful for managing your production, managing your day-to-day operations, and you can produce qualitative goods, qualitative services with the help of these particular assets, or with the help of other items. So if you want to purchase a fixed assets, then you definitely need money that can definitely use a fixed capital that will help you to set up a particular business, set up a factory, set up a premises, and furniture, equipment, because through these particular fixed assets, you will going to provide services, provide the assistance to your main production, right? So if you are busy in a main production, or main activities of producing a particular something or product and services, then definitely you need some fixed assets which will be helpful for providing a very good amount of supporting hand to you, to your business and the customer as well. So you definitely need a fixed asset. Apart from this, you are moving in a second point, that is your working capital requirement. If you want to manage a day-to-day operation, this is called the working capital requirement, right? Day-to-day operation definitely need a money, definitely need a finance. Whether you have to pay to your vendor on a regular basis, which provide you raw material on a regular basis, then you have to pay a certain amount of money. Then you are buying a raw material, then you are paying the casual wages or salaries to the laborers who are unskilled, who are semi-skilled. Sometimes you have to pay the utility bill of factories or the business. Sometimes you have to pay the rent, and sometimes you have to pay the electricity charges. So every time you are having a certain amount of daily basis expenses. So these daily basis expenses must be met out with the working capital, and working capital definitely help you to manage your operations. Apart from this, sometimes you have to pay the transportation charges, advertising charges. Sometimes you have to pay the upkeep van expenses, and other routine operations or the activities. Then all needs a working capital requirement. So on a daily basis, you need a working capital requirement. Working capital requirement might be reflected from the current assets and from your current liability. Current assets that might be part of a that might include the raw material. Sometimes you are paying your for your stock or inventory. Current liabilities that include your creditors, your vendors to whom you purchase the raw material or the other raw materials that might be helpful for your business, then you definitely require this working capital, right? So apart from this, you understand next point, that is the growth and expansions. If you want to expand your business, if you want to expand your service, whether you are doing a particular whether you are producing a particular product, whether you are producing a particular service, then you have to grow your production, you have to expand your production. In the same way, you have to grow and expand your service business. Then definitely here also requirement of money. So when a business intend to increase its production capacity, enter into markets, enter new product, establish additional branches, it require additional finances to support these expansion plan, right? So from a particular business who is only having a one particular branch, now it's want to open next branch, then definitely that business and its growth and expansion require a certain amount of money. So when business want to increase its production, increase its new market, new branches, and a new area, then definitely it need a finance. So growth and expansion also need a finance or the money. Fourth one, you are requiring the modernization, right? So business enterprises need fund to replace the outdated machine, right? Adopted new improved technologies, modern production techniques. These type of modernization definitely you might be fulfilled with the help of money. You are already having a particular machinery, particular technologies, or other various production techniques, but with the passage of time, you will experience wear and tear, outdated technologies, or new technologies taking the place in the markets, and your production techniques are improvised. So definitely you have to replace them with the new machinery, new technology, or new production technique. So every time when you modernize your business, then definitely it increase your business efficiencies, productivities, and competitiveness in the market. And definitely modernization is also possible with the only help of money. Now, apart from this, fifth point, it will help you in a diversification. Finance is also required when enterprises expand into new product or the business activities. Diversification helps reduce business risk and explore the new opportunities for growth. You are moving in a moving in a direction of a new production of a new product, new production of a new service, and these diversification definitely requirement have a further money and further expansion of your business and plans. So diversifications will help you to work along with the other product. Once you are already working with a particular product, now you have switched or you have introduced a new product or want to introduce a new product in the market, then definitely diversifications in terms of a new product will allow you to think in a particular direction, in particular product, in particular service, and all these diversification will only possible with the help of money. So finance is very much required for diversification of product and new service as well. Apart from this, next one and last one, the significance of business finance is unexpected business requirement. Sometimes you are doing a particular business, but suddenly a contingency arises, suddenly a situation arises which are out of your control, or that only need a certain amount of money which might be supportive to your unforeseen situation, contingency situation, then only requirements then might be fulfilled with the help of money. So business may face unforeseen situations such as an economic downturn, natural calamities, sudden increases in a cost or other emergencies. Adequate finances required enable the enterprises to deal with these such situations without disrupting the normal operation, because there are number of activities, number of normal operations that run on a daily basis, and finance will allow these kind of normal operation to be smoothened and to be done without any disruption. So in that case, you must maintain a certain amount of money in your hand, certain amount of finance in your hand, and adequate finances will allow the business and its operation to continue or perpetuate for a long period of time. And this particular business and related activities smoothen the operations, smoothen the production of the product, advertising of the product, marketing of the product, and selling of the product. And apart from this, various other official or administrative work might be possible with the help of finances. So these are the six major points of the significance of business finance, because business finance, business money, or money can, you can say, a lifeblood for a business. Without lifeblood, business cannot survive, cannot grow. So after understanding the significance of business finance, we will understand what are the various classification of sources of fund. According to this particular chapter, we will divide sources of finance in a three particular categories, that is based on a period of finance, that is based on ownership, and sources of generation. First is on the basis of the period. On the basis of period, finance can be divided into three particular categories: long-term finance, medium-term finance, and short-term finances. Or you can say resources, right? How much money you can get from the long-term resources, from the medium terms, and from the short term. So long-term resources provide finance for a period extending 5 years, right? More than 5 years, or money you require for a more than 5 years, then definitely comes under the purview of the long-term sources. These sources generally used for acquiring the fixed assets, expansion, diversification, and other long-term business requirements. Apart from this, we will understand the medium-term sources. Medium-term sources provide finance for a period of more than 1 year. As you know, long-term finance required for a more than 5 year. Medium-term sources require money for more than 1 year, but not exceeding the 5 years. So they are generally utilized for replacement of equipment which are damaged or depreciated due to normal wear tear, or due to normal protection, or being used in the production process. So they need a requirement, they need a replacement. So they are generally utilized for replacement of equipment, renovation, modernizations, and other medium-term financial needs. So this is one, this is your medium-term source. Now we are working on the short-term sources. Short-term sources finance or provide finance for a period of not exceeding 1 year. That is only for less than 12 months or a 1 year. These type of finances are mainly required to meet the working capital requirement or a routine operating expenses of the business. So these type of short-term finances is used for salary, wages, light and electricity bills, and many other day-to-day operations. So we need a short-term resources for a business point of view, in which daily money, daily finance is required, and routine operating expenses without these particular money is not possible. So we need short-term sources as well, modern-term resources as well, and the long-term resources as well. The long-term resources have its own purpose, medium-term resources has its own purpose, and the short-term resources has its own way of managing the day-to-day operation. Now we are working on a second point, that is the classification on the basis of ownership. We have already understood the period of finance, that is the long term, medium term, short term. Now we are understanding the ownership of the finance, or how the ownership or classification of ownership will be understand through this particular point. According to ownership, business finance is divided into two categories, right? How you can manage your finance, how you can collect your finance from the different sources. But in terms of ownership, you have two types of funds: owners fund and the borrower fund. Owner funds refers to the capital contributed by the owner of the business, right? Suppose you are an owner of a business, then you have to pay from your pocket you are taking from your friends, relatives, then you are managing your finances. Sometimes you are taking the help of equity share, preference share, retained earnings. So these are what? These are the honors fund. Honors fund will be collected through equity share, preference share, or retained earning. So these funds represent the honors investment in the enterprises and remain available for use over a long period of time. Right. Next, borrower fund. Borrower funds are obtained from the external source in the form of a loan and the borrowings. Right. You take the loan from the bank. You take the loan from others measures, other sources where you have to pay a particular amount of interest. Right. So such funds have to repay according to the agreed terms and usually involve the payment of interest. So these type of finances you need to pay on a regular basis or along with the principal amount along with the interest you have to pay on a regular basis whether you are earning profit or not. It is an obligation for your business to pay these kind of amount to back to its sources where you have taken this particular loan and along with the interest you have to pay this amount. So we will study this particular honors fund and a borrower fund in detail because this whole chapter is based on these particular honors funds and your borrowers fund. Next, you understand the classification on the basis of sources of generation, how you can generate the money, how you can use the finances. But here you will understand how your sources will be affected, whether it's an internal or whether it's a external. So on the basis of where the fund originate, sources of finance are classified into internal sources or external sources. Internal sources are the funds or the money generated from the within the business itself. One of the important internal sources mentioned in this chapter is retainer, right? Where a portion of a company's profit is reinvested instead of being distributed as a dividend. Retained earning is the amount of money, is the amount of part of a revenue that you usually save, you don't distribute it, usually save and distribute, you don't distribute it to your shareholder. And this amount of money which you save out of your revenue, out of your profit, it will be reinvested into the business for further business, further expansion or further growth or further production or any other activities. So this retained earning is your internal source of finances. Next, your external sources. External sources refer to the fund obtained from the outside the business. You definitely own this particular fund from other sources which is not belongs to your business. These include finance provided by the supplier, lender, or investor to meet the financial requirement of the enterprise. So these external sources is very much required for a business point of view because sometimes when you are not having your retained earning, your equity share, preference share, then you have to run your business with the help of these kind of external sources, which we study in this particular chapter. So here your generation of finances based on an internal or external sources. Now sources of business finance, we are going a little deep, and as we have discussed, we will study this particular source of finance from the two important point of view. First is your honors fund, second is your borrower fund. So now we will deep dive into honors fund and the borrowers fund. So honors funds refers to the capital contributed by the owner of a business. These funds provides a permanent financial base and remain invested in the business for a long period. So this particular honors fund will be managed by its owner of the business, and the owner of the business will collect the money from their personal sources, their personal regime, and they define or divide or develop their financial base and remain invested in the business for a long period. Now, what are these honors funds? Honors funds require three types of funds, that is equity share, preference shares, and your retained earnings. Now we study all three particular honors fund in detail. First is your equity shares. Equity shares represent ownership capital of a company. A person who purchases equity shares becomes a part owner of a company and is known as equity shareholder. Equity shares represent the ownership of a company, or a person who purchases equity shares becomes a part owner of a company and is known as an equity shareholder. Equity shareholders bear the ultimate risk of business because their return depend on the company's profit. For this reason, they are often referred to as the risk bearer of the companies. So equity shares is a share which is issued by the particular company to collect the money to manage the finances, and they issue the share into a particular market, or which allow the public to subscribe the particular share. Companies issue the shares, and general public subscribe these shares, and they buy the particular amount of shares from from in a different denominations, say 10, 20, 100, thousands. In such a denomination, they acquire the equity share. Against it, the public has to pay a certain amount of money for the equity share that they have subscribed, and this amount become the capital for the company, finance for the companies. So equity shareholders usually is a part owner of a business. They are not a fully owner. They ultimately earn the dividend for the invested money into the business. And this type of particular dividend is distributed by the company when they have a certain amount of profit or from the business activity, from the business operation. So equity shares basically particular money that the particular business collect from the general public by issuing the shares. Equity shareholders are the part owner of the companies, and they bear the risk from the business point of view, and they get the dividend from the company's profit, and this particular profit is considered as a dividend, is known as a dividend, and it is given to the equity shareholder. Now, what are the features of equity shares? So there are few features. First is ownership capital. Equity shares constitute the ownership capital of a company. Shareholders collectively own the company in a proportion to shares held by them. These shareholders subscribe certain amount of shares which are issued by the companies. Companies suppose issue the 10,000 shares, and few shares holders subscribe 1,000 shares, someone subscribe 500 shares, someone subscribe 300 shares, someone subscribe 500 1,000 shares. So there are different shareholders who collectively subscribe the shares issued by the companies, and against it, security shareholder pay the money to the company. This money becomes the capital of the firm, capital of the business. So equity shares generate the capital by issuing itself, and they helpful from the business point of view because from the money they collected from the business point of view, and become and the business will utilize these particular finance that is raised or that is generated from the equity point of view. That money is invested into the business generate a profit will be distributed as a form of dividend to these equity share against the capital they have invested. So ownership capital is part of equity shares, or features of the equity share capital. Second is your variable dividend. Equity shareholder do not receive a fixed dividend. Their dividend depend upon the profit earned by the company and the decision of the board of directors. If the company earn higher profit, they may receive a higher dividend. If the profit are low or unavailable, they may receive little or no dividend. So variable dividend means how many shares you have. Suppose you are having 100 share, and for each share you have paid a 10 rupees. So in this way you have contributed 1,000 rupees in a capital. Now the company earn a profit, say a 10,000 or 1 lakh, and as per your 1,000 rupees, it will be proportionate profit you will receive against your 1000 rupees. So whatever amount you are investing, you are getting the dividend, you are getting the revenue from the business, whatever profit they have generated. If suppose they are providing you a 10% dividend, so 1000 capital and 10% of dividend, so you will receive overall say 100 rupees as a dividend. So almost you are having money invested in the business, and against it you are getting the dividend, and this dividend rate is varied as per the number of share you have purchased, or it is as per the discretion or the decision of the board of directors. So board of directors decide that how much percentage of a dividend should be distributed to the shareholder, and accordingly your dividend rate will vary, your dividend amount will vary, and that's why we called it's a variable dividend. So as per the company norms, if the company is earning the more profit, higher profit, they will definitely provide you a higher dividend. Or if the firms or the company is earning low profit, low dividend, then definitely there might be sometime little dividend or a no dividend at all. So equity share definitely have a privilege being an owner of the company, but they have a risk of not getting the dividend for the money invested. So this is your variable dividend. Third one is voting right. Every equity shareholders have the right to participate in the management of the companies by exercising their voting right. They elect directors and vote on important matters placed before the shareholder in a general meeting. So every equity shareholders has a voting right. They can vote or participate in the management activities. What should be in a good manner, or the decision point of view, for a business point of view, they will vote for the company's management, they vote for the company's activity, they vote for the company's betterment and the future requirements, and accordingly, when they have a voting right, they are able to elect the director who will manage the or administer the overall functioning and operation of the business and the organization. So voting right will help the companies. Voting right help the shareholders to manage their business, manage their organizations, because there are number of equity shareholders in the market who subscribe the company's share, but they cannot become the manager, they cannot manage the day-to-day operation of the business. That's why they have a voting right to elect a particular directors or a group of directors who will manage or administer their companies on their behalf. So this voting right will help the companies, help the shareholder to manage their day-to-day operation, manage their function, activities, tasks on a regular basis, and it will smoothen the operation of the business for a long period of time and have a long-lasting impact for the business point of view. So in this way, you are also having the voting right. Next is your residual claims. Every equity shareholders have a residual claims over the company's assets after the claim of the creditors and a preference shareholders having been fulfilled settled. The remaining assets, if any, belong to the equity shareholders. So this is a point that will work at the time of winding up of the company, at the time of close down of the company and its operation. So when the equity shareholder have their residual income, that will be distributed to them only after once the company has paid to the creditor and your preference shareholder, and whatever money or whatever the assets is remain in the business, it will given to the equity shareholders, or sometime remaining assets will be sold, and the whatever money that has been collected from selling of the particular asset will be distributed among the equity shareholder. The equity shareholder have the residual right uh, very very last after the creditor and your preference shareholder. But creditors and preference shareholder have a preferential right to get their money back once the company is closed down. Creditors need to pay on a regular basis. Creditors have a right to pay their dues at the time of close down on a preferential basis. After this, preference shareholder will get their principal amount or capital, and whatever money is due to them. And after that, if any amount is sustained, then it will be given to the equity shareholder. So in this way, they have a residual claim in the business point of view. Next is our higher risk and higher returns. Since equity shareholders receive returns only after meeting all the other obligations, they bear greater business risk. However, they also have opportunity to earn higher return when the company performs well. So in this way, they face both the risk and returns. If they are having a major risk, then their return are also major. If the company is earning more profit, their the chance of earning the more dividend is also higher. So higher risk is also associated with the higher returns. Equity shareholders is bearing a more risk than they have a chance of hiring or managing the more revenue from the business point of view. So more risk is associated with the more return. If equity shareholders bear the more risk, then they might also earn more revenue from the business point of view, or sometimes vice versa. Now we understanding the merits of equity shareholder. First merit is permanent source of capital. Equity shares capital remain invested in the business and does not have to repay during the lifetime of the companies. This amount of money or this amount of capital might be returned only at the time of winding up of the companies. Before this, it is not possible. Second is your fixed no fixed financial burden. The company is not legally bound to pay dividend every year. Dividend is declared only when sufficient profits are available. This is the very good merit of this particular equity shareholder, because the companies is not legally bound to pay the dividend on a regular basis. Sometimes if they are not earning the certain amount of profit and then they are not able to distribute the profit, then they can refuse it to the equity shareholders very clearly. So there is a no fixed financial burden from the business point of view or from the company's point of view. Third one is it improves the credit worthiness. A large equity base increases the company's financial strength and enhance its ability to raise additional fund from lender. This is very important point, and this particular point will allow the companies to strengthen its financial situation and financial position, and they will definitely able to capture or raise additional fund from the lender, because the lender also know that if the companies are performing well, then definitely they will earn a more profit and a more return from the particular business. So improvements that improve the credit worthiness from the lender's point of view, and the company is earning a more return, a more profit, and they are able to distribute a more dividend to its shareholder, then definitely other shareholder, other lender would be attracted to pay or to capture or to subscribe more equity shareholder from the business point of view. So it will improve the credit worthiness. Next is your suitable for expansion. Since equity capital remain permanently available, it is particularly useful for financing long-term expansion and growth. Equity shareholder definitely helpful for expansion and growth of the business. It will this will allow the business to expand its branches and in- introduce new product, new services. They also helpful in the make their presence in the new market and in for a new with the new product. So these kind of expansion definitely need a strong amount of money from the business point of view, and equity capital is also helpful in this particular regards. So suitability for the expansion we can assume from the equity point of view, and expansion only will possible with the help of equity shareholder, because they do not have to pay their capital equity shareholder on a regular basis, or they do not have to pay the dividend on a regular basis, so they can continue with that particular capital, and this particular capital will allow the business for expansion and for more growth. Next is your limitation of equity share. First is dilution of the control. Issuing the additional equity shares may reduce the control of existing shareholder, because voting power get distributed among a large number of shares. So once you are able to channelize your power in the hands of number of shareholders who have subscribed the company shares, then definitely power will be diluted, and it will be in the hands of the shareholder, and this particular dilution will reduce the control of the company, and it will lose the control in the hands of the shareholder. The shareholder will try to manage the company from their own point of view. They will try to direct the company from their point of view. They will vote against sometime the companies and its decisions. So this will reduce the overall control. So equity shareholders have this major limitation in the form of dilution of control. Next is your costly sources of finances. Equity shares generally involve higher issue expenses and often consider a relatively expensive sources of finance. So this is particularly uh, cost costly source of finance, because this particular equity shareholders will need higher issue expenses. Sometimes they have to design the prospect, then you have to hire the underwriters who will sell the shares from their point of view, and these all activities and these all tasks will capture or attract the more expensive. So raising the capital from the equity point of view, or raising the capital from the equity shares point of view, is a quite expensive and often a relatively more expensive source of finance. After this, third point is higher expectation on investor. Since equity shareholders bear a great risk, they usually expect higher returns on their investment. So this is a particularly expectations of the equity shareholder or the investor, because they think that they assume that we have invested a huge amount of capital in the business, then definitely we are also bearing the great amount of risk. Then definitely we should earn more revenue than the preference share and the any other outside liabilities. So this expectation is very problematic from the business point of view as well, because this will allow, or this will create a pressure on the business activities or the business operation, and they will pressures on the existing selling and the production department, in which they would be able to make qualitative goods, and more selling would also be possible, and more selling will be possible, and then only they can generate a more revenue, and then only they can distribute more dividend as well. So this expectation will create a very problematic situation from the business point of view. So higher expectation of investor will create a problem for business and the organization. Next, we are discussing our preference shares. Preference shares are the shares that provide a certain preferential right over equity shareholder. These shareholders enjoy priority with respect to payment of a dividend, repayment of a capital at the time of winding of the companies. This is the two important conditions which you should know. If you are dealing with a preference shareholders, they will need a dividend, and they need to pay capital at the time of winding of the company just before the equity shares. We need to provide a regular dividend to them. We need to provide capital before the equity share holder at the time of winding up of the companies. So because of these preferences, investors seek a relatively stable income after often prefer investing in a preference share. So very less peoples are there, or very less shareholders who invest in the equity share. They better to invest, or they prefer to invest in the preference shareholder, because preference shareholder definitely provide a dividend, and their capital are safe, and their capital is to be provided at the time of winding up or at the close down of the business. So a company issue different type of preference shares according to the financial requirements. Now, after understanding the preference shares, we will study its feature. Preference shares or preference share have a preferential right to get a dividend. So preference shareholder receive dividend before any dividend is paid to equal shareholder. We have already discussed this point. preferential right to repayment of their capital at the time of liquidation, at the time of winding up, at the time of close down of a business. Preference shareholders must be given their capital before the equity shareholder. So this is the preferential condition, preferential situations that must be fulfilled from the business point of view in terms of dividend or in terms of repayment of capital. Next is your fixed rate dividend. Preference shareholders generally receive dividend at a predetermined rate or a fixed rate at the time of issue, right? So they have a fixed rate of dividend. After this, they have a limited voting right. In comparison to equity shareholders, preference shares holder, they do not have any right. They do not they do not cast the vote for the any discussion or the decision taken by the management. The preference shareholder generally do not enjoy the same voting right as equity share have, except in a matter directly affecting their rights as provided under the laws. So these are the main features of the preference share. After this, we will understand the merit of preference share. In comparison to the equity shares who dilute the management control, that is considered as a limitation of the preference share, but this becomes the merit of the preference share. Because preference shares cannot dilute the management control, it means that they are not having a voting right, so they do not have any type of control on the management activities and its operation. So since the preference share holder generally have a limited voting right, management control of existing equity shares remain largely unaffected. So they cannot control, they cannot manage the control of the any business. Next is fixed financial commitment. The rate of dividend is fixed, making it easier for a company to estimate its financial obligation. From the business point of view, business has to be of business has to be obliged to pay their dividend on a fixed rate. Then their commitment towards the preference shareholder is limited. Their commitment is fixed, and they do not have to pay dividend on the basis of a varying rate. And in this case, they are just fulfilling the more responsibilities just to pay fixed financial commitment, fixed financial dividend. So the rate of dividend is fixed and making easier for a company to estimate its financial obligation. They do not have to worry about any other amount of finance that should be given to the preference shareholder. Next is your attractive to the conservative investor. Preference shares are suitable for investor who prefer regular and a comparative stable returns with lower risk than the equity shareholder. So this is very much important, and this particular point will allow the conservative investors who are very much conservative in terms of money, in terms of dividend. They are not having a so much open mind in investing their money into the inform as a equity shareholder. They are not able to bear the greater risk, then definitely will focus on the preference share. The preference shares are suitable for investors who prefer regular and a comparative stable income with lower risk than the equity shares. So this is the merits of preference share points of view. Next is limitation of the preference share. First is your fixed dividend obligation. All the dividend is paid only when declared. Company is expected to honor the fixed dividend preference share before distributing profit to the equity shareholder. This is the limitation. They just have to pay fixed dividend. They cannot vary the dividend rate as per the profit or profit increase or decrease. It will not change. So a fixed amount of dividend will be given to the preference shareholder, and they cannot demand more dividend if the profit is generated in the business more than their expectation. Next is your comparatively costly. Preferential capital may prove more expensive than certain forms of borrowed finances because dividend is paid out of the profit after the taxes. So comparatively costly because this particular dividend is paid once you pay a certain amount of tax on a profit, and after residual profit, that profit is given in a form of a dividend to the preference shareholder. So this is very expensive, and this is expensive in terms of the money, and there only a certain amount of profit will be available in the business once you pay the taxes, and from that profit, after profit tax, you have to pay to your preference shareholder, they have to pay equity shareholder, and that's why this preference shares capital becomes more expensive from the business point of view, because in equity share we do not require to pay a regular dividend, or they cannot demand as well, but preference share shareholder may demand regular dividend, and this dividend should be paid just after paying the tax on the profit. So this is very crucial and very comparatively costly. Next is your retained earnings. Retained earnings refers to the company's net profit, and this is your owners fund, right? This is your owners fund, and this particular point will allow you to give you the amount of profit, or to manage your business with the amount available with the companies. So retained earning is a earning that you say that you hide out of the profit, and this particular money is reinvested in the business so that you can continue your business for a long period of time. So retained earning refer to that portion of the company's net profit which is not distributed among the shareholder as a dividend, but is retained or reinvested in the business. These accumulated profit serve as important internal sources of finances. This is considered as internal source of finance, which we have discussed earlier, and are generally utilized for the company's growth and expansion point of view. This amount is not distributed at all, right? Firms reinvest this amount, plug back this particular profit into the business, and this amount available as retained earning, and it depends largely upon the company's dividend policies. So dividend policies should be like as there should be dividend should be available for the equity share, dividend should be available for the preference share, and certain amount of dividend should be saved or not distributed to any shareholder, whether it's equity share or preference share, but it should helpful for the business point of view, because this retained earning will not allow the business to take any money or any finance from the other sources. If you are having a such sufficient amount of retained earning in your business, then business does not require any amount of finance and money from any other sources. So retained earnings should be proper in your business. If this is not possible, then you can move to other sources of finance. Now we understand the merit of the retained earning. This retained earning is readily available sources of finance. The companies can utilize retained earnings without depending on the external agencies. Next is your economical source. Since no flotation cost are or the issue expenses are involved, retained earnings provide finance at a comparatively low cost. For the equity shareholder, you have to manage your issue expenses or the flotation cost. In the same way, if you want to issue preference share, then you have to manage your flotation cost and your issue expenses. But if you are managing your retained earnings in a very particular manner, then you do not have to follow or do not have to manage your finance, manage your issue and your flotation cost. So this at the time of managing your finance, managing your money, it becomes a very comparatively lower cost assets for the business point of view. At last, we third point, that improves the financial stability. Accumulated profits strengthen the financial position of the company, and it increases its ability to withstand business uncertainties. Fourth one, it supports the growth and expansion. Retained earning provide funds for expansion, diversification, modernization, and replacement of the assets. And at last, we are studying its limitation. What are the limitation of retained earning? First, dissatisfaction among the shareholders. If a company retain a large portion of its profit, shareholder expecting a regular dividend may become dissatisfied. Second, possibility of misuse. Large retained earnings may increase insufficient utilization of fund and unnecessary expansion of the management. And third one is limited availabilities. The amount of retained earnings depends upon the company's profitability and dividend policies. Therefore, newly established or less profitable companies may not have a sufficient retained earnings. So, in all 3 points, dissatisfaction among the shareholders, it will create a dissatisfying point of view among the shareholder, because if they know that particular company is having a certain amount of retained earning and why they are not distributing, then definitely it will create a dissatisfaction among the shareholder. So shareholder wants to make the dividend purely available to them. Second, if you are having a more than the sufficient amount of profit as a retained earning, then it will be misused in the business, and your money will be utilized in a very haphazard manner, and your money will be utilized in an unnecessary direction, and this will allow the management to use from their point of view whether it might be economical or not. So second point is very much crucial. Third one is limited availabilities. If amount of retained earning depends upon the company's profitabilities and dividend policies, then newly established or less profitable companies may not have a sufficient retained earning. Because if you are just establish your business, or if you are new to the industries, then retained earning would not be possible for your business. After spending 4 to 5 years, say 10 years, then you will definitely having a certain return earning in your business. But at the starting of the business, or the inception, or at the outset of the business, then you will not be able to maintain this return earning for a long period of time, and you would not generate this return earning because this is not easily available, because your company would not issue the equity shareholder equity share preference share. You only depends upon the long-term finances or borrowed finances, that will be discussed in the next video. So far we have discussed honors fund, that include the equity shareholder, preference shareholder, and your retained earnings. Hope you have understood this particular point related with the honors fund, and hope you have like and share this particular video, and definitely this particular video will be helpful for your understanding in a particular chapter that related with the source of business finance. And if you listen this chapter carefully, then definitely you will be able to clear your doubt, clear your problems of honors fund. So thank you very much for listening this video, and hope you will like this particular video as of now, and you can like, subscribe, and share with your friend. We will share the borrowers fund in the next video. Till then, you can read it out, or you can listen this particular video, and you can clear your doubt, and see you in the next video. Till then, take care and have a nice day.